Good day, ADK Wealth Advisory Group and Financial Planning World Community. Dan Davis, 2023 Market Outlook. Hard to imagine that we're already here. How many times have you tried to write the date and put 22? I know that it's been a few for me. So welcome to 2023. May it be ever so much better than 2022, which if you really take a look at our expectations for 23, it's 80% likelihood that you'll see an economic slowdown to the point where it'll either be a official recession or very, very close to one. Expecting it sometime April to June in that time frame. What I've been asked a lot is, what do you think that means to the financial market? So I'm going to start with the bond market first. If you take a look at 2022, the Fed was very aggressive at managing inflation and raised interest rates a lot, one of the worst bond markets in my career. We think it's almost the exact opposite of that this year from a standpoint of not that the Fed's going to be loosening, but that the bond market will do quite well. And what does that mean? Probably the Fed raises in February. Probably they raise one more time after that. And then it'll depend on what happens data-wise with inflation. If Fidelity, who we've talked to about this ad nauseum, is accurate, inflation, in their view, has peaked and is now starting to come down. They believe the Fed will raise rates in those two meetings by 1/4 point, and then we'll cease and desist. The market itself has priced in the fact that they think the Fed will actually lower rates next year. Fidelity nor ADK believe that they'll actually lower rates next year. All of that said, our outlook for bonds is favorable. If you take a look at coupons for high-quality bonds, you're really talking somewhere 4 to 6% as a reasonable guesstimate of what we expect rate of return from bonds. You'll see a chart that I'm putting up right now, and there's a continuum of interest rate risk and credit risk. Where we're at in the economic cycle will cause us to lean either higher quality with interest rate risk away from credit risk, or assuming credit risk. The reason you want to avoid credit risk at this particular stage is credit risk really gets hurt the most when you have a recession. And since we think we're approaching that, we'll be shoring that up. We've already made some moves literally today, and we made some moves the last part of December to be moving us away from credit risk. Those moves will be finished in February. If I were then to shift gears to the equity market, if you go back and you say, okay, stock market kind of went sideways with some big ups and downs from about June to now, that's what we're expecting. That's our base case. We expect that until we're about midway through this possible recession that we're alluding to. Why? I can't give you a good explanation, but the stock market historically in the midst of a recession will start to recover. Therefore, they call it a leading indicator. And we would expect that to happen here, is somewhere in the midst of the recession that the stock market would start its recovery. If the recession happens in April, then we see a good part of that recovery this calendar year. If that recession starts in June, we probably don't see much of that recovery this year. And I don't think anyone can give you a reasonable target of when that recession would be, other than somewhat of a short of a range. Our base case, we outlined the sort of an alternative scenario, which would be much more optimistic. The Fed, while they do the rates increases that we're talking about, gives dovish language. And if that happens, I think the best case scenario could be that the stock market recovers almost immediately, which we would hope that would happen. I wouldn't bet that way. Draconian situation, as many of you have heard us talk about, is something happens with tactical nukes from Russia. If that occurs, then everything I just talked about sort of off the table. We would be forced into taking risk reduction moves, meaning moving equities to things like cash, treasuries, gold, things like that. How do you measure that risk? No one can. The best I can tell you is that to try to project if it will or won't is fool's play, and we would be more reactive to that. But it would be a very, very quick reaction. The investment committee has concluded that the immediate reaction once the markets would be open would be that we would go in electronically and reduce our equity exposure by a minimum of 50%. That would be an immediate, and then the investment committee would be convening to discuss how much more and how quickly would we do the rest. Still, we would end up losing money because if it happens after hours, when the market opens, it's going to plummet. And if it happens in the midst of it, before anyone can do anything, the market will plummet. It's just saving some of the possible downward spiral that the markets could incur. So best case scenario, Fed gets dovish in their language. Base scenario, market stays sideways for a while. Worst case scenario, hard to measure, but we're taking it very serious. We're not being Pollyannish about the fact that it wouldn't happen. I don't think it's going to happen, but one never knows. So 2023 outlook is really, I'd say, much more of a first half than a full year, because once the recession would come in, that would give us a little bit more visibility into when we think the sideways would end. So I want to wrap up by saying thank you for your trust. I know 2022 was a really, really rough year for everyone. We appreciate the ongoing trust. If there's anything you need, just reach out. We're here to help you out. Signing off from the St. Louis office. Have a great day and Happy New Year.